Welcome to Module 2, Session 3, Basic Financial Projection for SMEs, where you will learn how to turn business plans into financial expectations. My name is Chinyere Otuonye, a National Business Development Support Provider licensed by Small and Medium Enterprise Development Agency of Nigeria, SMEDAN, and a certified digitalization consultant by GIZ. I will be your facilitator for this session. By the end of this session, you will understand what financial projections are and why they matter. You will estimate projected revenue for your SMEs, project their business expenses realistically, estimate future profit or loss, and use simple projection tools suitable for small businesses. The learning focus will be to help your SME client estimate their future income, costs, and profitability to support structured growth plans. So, what is a financial projection? What do you think it means? Generally, we'll say a financial projection is an estimate of a business' future financial performance based on current data and planned improvements. It helps businesses answer questions such as, how much revenue can we generate? What will our expenses look like? Will the business be profitable? How much capital is required for growth? Financial projections are not guesses. They are informed estimates based on realistic assumptions. So as a BDSP, you must understand projections because you are to help your SME client plan for growth, understand their financial targets, control expenses, prepare for funding opportunities, and make better decisions. So for BDSPs, projections will help you to evaluate improvement plans, measure future business potentials, and demonstrate impact to funders or programs. The three core components of a simple financial projection. As a BDSP, you must understand that basic SME projections focus on three elements, which are the projected revenue, the projected expenses, and the projected profits. To calculate revenue projections, you need to determine the average price per product or service and the expected number of sales when you are calculating a projected revenue, because projected revenue estimates expected sales. So the formula for it is the price multiplied by the expected sales. Let's look at the example where cakes are being sold at 5,000 naira a piece, and there is a projected sales of 40 cakes in a month, which will give us 5,000 times 40, 200,000 naira per month. So based on past data, market demand, and planned marketing, this business expects to generate a revenue of 200,000 naira from selling 40 cakes. Projected expenses. This estimates future business costs. Here you need to separate expenses into two categories of fixed costs and variable costs. Fixed costs are costs that remain constant regardless of sales. Things like rent, salaries, utilities in some cases, internet, and equipment maintenance. Whereas variable costs are costs that increase with production or sales, like the raw materials you use for your production, the packaging materials used to package the finished goods, delivery, because this is dependent on customers' request and demand, and then the transaction fees. So let's look at the example where expenses and they are correspondingly corresponding monthly costs are shown on screen. The rent is 50,000 naira, ingredients cost 80,000 naira, staff salary is 40,000 naira, and packaging is 10,000 naira. The formula for getting the projected expenses is the total sum of all expenses, both fixed and variable, and this gives us a total projected cost of 180,000 naira. Projected profit. This is the profit um, gotten by deducting the projected expenses from projected revenue. So using the example projected revenue of 200,000, in this case, the projected expenses of 180,000 naira. The projected profit is now 20,000 naira because we subtract projected expenses from projected revenue. Simple 3-month projection. You need to learn to develop short-term projections for your SME clients. This will help your SME clients monitor progress and adjust plans based on marketing activities, seasonal demand, and operational improvements. So let's look at the example on screen for a 3-month projection, which covers the projected revenue, projected expenses, and projected profit. Remember, projections may change based on marketing activities, seasonal demand, and operational improvements. So there is the need to review your projections regularly. Linking projections to impact improvement. Financial projections must reflect the planned intervention. Looking at the example of an improvement plan where there's a plan to increase marketing activity and it has an expected impact of increasing customer inquiries and sales. The projection adjustment will now follow the route of current monthly revenue is 150,000 naira and there is an expected increase after marketing of 20%. Therefore, the projected revenue equals 180,000 naira. This is obtained by multiplying 150,000 naira by 20 over 100. Then you now add that figure to the current monthly revenue. Common mistakes in financial projections. As BDSPs, we may get carried away and then commit these common mistakes when we are providing financial projections for our SME clients. So please take note of these. These includes overestimating revenue, where you project sales figures that are not supported by evidence or market conditions. Like cases where you say as a new business, you'll be able to sell to 10,000 clients in your first month of sales, and without commensurate evidence, you are not tech enabled, you are going to do brick and mortar. You're solving a business problem for a brick and mortar business that do not have previous customers, is just entering into the market. You're overestimating your revenue. Then when you're ignoring hidden costs, like you're failing to account for all expenses, including communication, transport, especially variable and irregular costs. Then when you are making unrealistic assumptions, using assumptions not grounded in current business data or market realities, or when you now fail to review regularly. Remember, projections must be updated as business conditions and plans evolve. So as a BDSP, you must ensure that your projections remain realistic and evidence-based. Let's look at this case study of a tailoring business that provides custom outfits. The current situation says that their price per outfit is 15,000 naira. Average orders of 10 comes in per month, and they have a planned marketing to expecting to increase orders to 15. So their monthly expense is shop rent 40,000 naira, fabric purchase 70,000 naira, electricity 10,000 naira, and assistant salary is 30,000 naira. If we are to calculate the projected monthly revenue, will arrive at 225,000 naira following the formula and calculations given on screen. So from this, we'll now get a projected expense of 150,000 naira from the table given and the projected profit, where you subtract the projected expenses from the projected revenue and you get a 75,000 naira projected profit. So as a BDSP, how can you now use projections in your profit? You can use it to evaluate viability by assessing whether improvement plans are financially viable before implementation. You can also help in investment readiness by preparing your SMEs to present credible financial data to funders and investors. It guides decisions when you use projections to inform strategic decisions about growth and resource allocation. And you can track progress by monitoring actual performance against projections after interventions are implemented. So financial projections also help demonstrate economic impact. For your field assignment, work with your assigned SME to estimate their current financials, where you check the current monthly revenue and monthly expense. So you develop a 3-month financial projection, and you now align projections with the improvement plans that you have earlier designed. Submit your projection table and a short explanation of assumptions when you're done privately. I expect that upon completing this session, you should have your SME baseline report, your SMART goals, your improvement plans, and basic financial projection for each SME client. So the key message I want to leave you with is that as a BDSP, you do not only solve business problems, you help businesses predict and plan their financial future. Businesses grow faster when they understand where their numbers are going. So with this, we've come to the end of this module and session. My name is Shinyere Tuonye, the founder of Sparks Ventures Hub at Ogui Road, Enugu, Nigeria. You can follow me on LinkedIn, visit our website, sparksventureshub.com for more. And please like, follow, and comment. Thank you very much.